Welcome to the Music X podcast with myself, Maarten Wolraven, and Gareth Deacon. Hello, Gareth. Music X is a newsletter that I write together with a strategic writer collective, and we cover music, technology, innovation. It's published every Thursday, and it's no hype reporting on the music industry. And it's all about curiosity about mostly where culture is going, but also importantly, where the capital is moving. And that's what we're focusing on in today's podcast as well, where we have Severin Zugmayr and Victoria Fäh. Gareth.
It was a super fascinating conversation. Both Victoria and Severin are incredibly smart people with incredibly deep backgrounds in investment and financing in both technology and the future and content of IP. IPRVC, where Victoria works and has set up the lab to think about the future of IP, traditionally invests and has an alternative model for investing in TV and film content. And now she spends her time thinking about the future of IP and content and where we're going. Severin set up New Renaissance Ventures specifically to take a kind of tech thesis where they saw a gap and invest in technology around creative and culture industries. So both of them are like super fascinating people. They take us outside of our echo chamber around music and how these things play out in music. But more importantly, both of them have pretty contrarian ideas and approaches to the traditional thought process, even within the venture and investment community, about how you fund the areas that they're most interested in. So as a conversation, ticks all the boxes in terms of taking us well and truly outside our comfort zone. So it's a fascinating conversation.
Let's dig in.
I kind of want to kick us off, right? So one of the things that's always like stood as interesting when we were trying to choose guests for how we wanted to start thinking about like kind of money and the role of investment in kind of music and creative industries was both of you hold somewhat contrarian views to, I think, how most people think about the role of investors traditionally in culture and creative industries. And I would say like one of the things that stood out, I kind of wanted to jump in on kind of first was particularly Severin, looking at things you've been writing about and the work you guys do, I think the creative industry generally feels like it's underinvested. But then specifically things you've looked at has sort of said something quite different about like actually how that looks and what is actually happening underneath. So I think from a sort of creative industries sort of investment kind of opportunity and point of view, the thing I would love for us to kick off is like kicking around like kind of your views, both of you, on kind of like that opportunity and what's actually happening and the point of view from where you both sit. And I think we'll get there, and then let's see where the conversation takes us. So, Severin, what am I saying with you?
Yeah, no, happy to kick it off, and thanks for having us. Obviously, I'm very happy to have this conversation. Yeah, I mean, before I started the fund, I had the kind of same thinking. Creative industries seem to be very underrepresented and overlooked in the world of venture, right? Specifically from this venture capital perspective. And back then I started to do a bit of an analysis, dig a bit deeper, try to understand, okay, how much venture money is actually going into those creative industries. The first challenge was there was not really, that category doesn't really exist, right? So trying to do research is even already quite hard because it's not like in fintech or health tech where you have very clear reports and know exactly the numbers. Creative industry seems to be much more fragmented. So my proxy was looking at obviously the very big funds out there, the Sequoias and A16Cs of the world, and looking at their portfolio, right? And trying to understand, okay, how much money are they actually deploying into creative tech? And to my surprise, that number was actually very high, right? I was thinking like, okay, this is like in the single digits, 3-4%, some lucky shots in the creative tech space. But I found actually a more systematic approach. I mean, not a systematic approach, but like there was much more money going into those sectors than I expected. And
can you say how you defined that creative tech sector, since
Sure.
it didn't exist yet as a category?
Yeah, fair question. I mean, when I started the fund, I was more or less following the definition of the European Union, right? Being domiciled here. And there is a very clear definition of what creative industries are. And it goes anything from music, entertainment, gaming, film, obviously, publishing, media, graphic design, photography. So everything which touches creative workflows, or the distribution and monetization of creative assets, IP, is what I consider creative industries. And under this kind of definition, the portfolio count of these big funds is like 8 to 10% roughly. So of every 10 companies, basically one company is in creative industries, which is quite a lot, right? If you consider there's tons of other categories as well. So yeah, I mean, to your initial question, Gareth, it is overlooked, but at the same time, there is already a lot of funding going into that. I think it's just a question of classification or like how you structure that. So and that's been like the core thesis of the fund, right? Trying to build a platform and an ecosystem dedicated for tech founders in the creative industries.
On that definitions point, then, so Victoria, you come from a background where you had an alternative funding model for like IP and content anyway, but then looking at from the lab side of things, like what does the future look like, and new formats? Can we dig into what are these investable things within creative industries, etc.? Because it seems like that's a logical place to kind of like dig a bit deeper and unpack.
Yeah. I mean, also, yeah, thank you so much for having us as well. So yeah, I think we sit kind of a little bit on a different side to where Severin is. So as the name of the fund says, IPRVC really stands for intellectual property rights. And that is really the kind of the asset that we see being incredibly valuable, you know, in the long term as well as in the short term. And that has been kind of the history of the firm, which has been around for now 12 years. And historically, that was pretty varied in terms of, you know, looking at IP, gaming, film, television. We did investments into animation businesses, a e-commerce kind of platform. And that has then evolved into film and TV. And as you say, Gareth, when I joined IPR 2 years ago, the idea was to really dig deep into what is IP and content really going to mean in the near future, and how do you actually truly invest in it because of the technological shifts, audience behavior, distribution. And what we started to do was actually just to kind of dig a little bit deeper and how do we need to redefine intellectual property in itself. Because I think across all of those sectors that like Severin mentioned, I think everyone uses different terminology, and actually that's really difficult. Or content means something very different to someone in the gaming space than it does to someone in music. And the kind of conclusion we came to was to say IP traditionally was, if you have a piece of IP, a book, we've written something down, does that have truly value? And for us as IP investors, we need to understand where does that value accrue and who does that value go towards or to? And so we started to see that actually, and that has always been the case, at least since streaming and before, is that the IP value really goes to the ones who can reach their customers. So it often is in the distribution and the monetization stage later on. And for us, that then meant that we started to look at IP in a way that is much more about including the audience, including the consumer into it, rather than saying it's purely the asset, the thing, the book, the game, the film, the content. It is as much about the audience to consumer, and that is a true part of the IP itself. Truly is about thinking, how is that piece of IP gonna reach its audience over the long term repeatedly and truly build value in that way? And so I think we're still, you know, refining exactly what that looks like in terms of from an investment thesis point of view. But I think even with the things that we've done this year and the last year with Marty Supreme, the film, you know, those examples really show that they're incredible at building amazing kind of audience connection. And I think that just continues to be one of the clearest kind of moats that you need to build in this kind of IP and content space.
Yeah. It's funny because when I set up the fund, I was struggling with that question: where do I make this delineation between like tech tool versus like IP investment? And I thought I need to be very clear. I'm not doing IP, and that's also what I told all the LPs. And I was very like, I'm not doing IP because I have no clue about IP, right? I might have taste, right? But I clearly don't have the means to evaluate what is a good IP and what is not a good IP. But the reality is this is becoming very blurry. And I mean, we see transmedial assets, we see like user-generated content, we see a lot of tools where there is IP being generated as a result of that. So I think it's super, super interesting because you can't do this in a siloed kind of strategy. You always have to think in both ways. But that being said, I still think in kind of like tooling tech first, because that's the world where I'm coming from. But it's very interesting to see where there is, I mean, in the majority of my companies and investments, there is a strong IP angle, right? Even though I don't necessarily look at it from an IP angle. And I
Yes.
get that also with you, Victoria, right? With the lab, right?
Exactly. No, I think it's so interesting you mentioned that, because I think that's exactly the point we come to as well, is that you cannot ignore technology when it comes to IP and content investments. Of course, they are dependent on the underlying technology, not only in terms of creation, but also in terms of distribution. So I think I completely agree with you that that line is very blurred. And which also actually from a funding perspective for these startups, I think is quite interesting. If you are, a startup in that space, you could have two different investors, one with more of a tech angle, one with more of an IP angle on the same cap table, which actually could be a really interesting set of people to work with, because we would both come from a very different angle, but see that there's value in both. So I think that's the view I've had a little bit, which I think could actually be, an interesting collaboration.
I mean that's fascinating, because essentially also different structures in terms of timings of how revenue gets thrown out of those things. The traditional model on most startups is their fairly long-term bets to get to a certain amount of revenue in many cases, or find product market fit, compared to content that sometimes is throwing out revenue outside of production timescales and other things. Theoretically much quicker. Like, certainly in music, there used to be this very clear delineation between like the sort of IP part of the business, artist facing side of the business that did all this stuff, the business side of stuff. And with technology, it was very much the same true. Like, most companies were not necessarily dealing with artists or the IP side in the way that it is now. And now you've got this place where even the types of companies that are very much involved in, production or making of music, everything from, synths and VSTs to maybe video generation or generative AI music platforms, like that line is so blurry at this point. It's incredibly difficult to make that differentiation, which from a definitions point of view. So I'm fascinated with that. Then as that's changing, like, how do you keep a rudder on kind of how you both think about, like, kind of, because you both make bets on the future to a certain extent, right? So it's like, how do you manage that? Like how is time collapsing in slightly and technology speed like affecting, or is it not? Is the rudder very much both, because both of you are also anchored in a view that's based on starting from a lens of what the traditional sectors you both come from, kind of how they operate or do or don't function in this new world. So like, I'm fascinated to unpack that idea.
Victor, no, happy to kick it off. I think you mentioned an interesting point is kind of this consumerization, right? Like that, like business models becoming more consumerized. And I think one reason is why that is happening is because just cost and time is like rapidly going down, right, in content creation. And if you just apply this to music, also, we obviously see a democratization of music creation, right? Suno or Mozart AI, or however you want to mention these companies as examples. And that obviously, as a result, opens up this part of content creation to a much broader audience, right? And you suddenly have a long tail of music creators, which was not the case before, because the barriers to entry or the barriers to create content were much, much higher, right? And that also, as a result, then again, as another factor, kind of also rebuilds the whole distribution stack, right? Because you don't need this intermediary layer. Then you can just basically go from creator to distribution, right? And I think these are two kind of core theses, and this doesn't only apply to music. Obviously, it applies to all different assets. Drives a lot of my thesis in each of those subverticals. So the democratization of content creation, so reduction of cost and time, and kind of the rebuilding of distribution and monetization.
I was actually going to come from it from a slightly different point of view. If you look at, for example, how IPR kind of functions with, for example, our current funds, like the way that we invest is not like a traditional VC. So time plays a huge role in that. There's kind of two metrics that you look at. It's IRR and it's DPI. How quickly are investors getting their money back? What's obviously really interesting about film as an asset class or content as an asset class is that it can generate revenue, as you say, relatively quickly. When you are getting revenues from that, that makes it a really interesting way of investing in the space and an interesting kind of fund model. And so for us, the interesting thing has been to almost offer something different to institutional investors that is not necessarily dependent on that kind of exit point. But just from a pure kind of fund level, I think media and content IP as a direct asset class already is relatively fast compared to other assets.
So I've got a question that both of like what you're saying is making me like sort of have like a question itch on is like, okay, so if this sort of speed and time to either revenue or return is essentially fast anyway, but decreasing potentially is kind of thing because cost in some way is decreasing. Does it mean that like capital is more important earlier, like as an injection, and actually the need for much later stages of capital raising is or is not as necessary as we go forwards, and then the return is greater, right? Or not? Like how do you look at how that's changing the dynamics from the point of view of kind of the return on those investments and the sort of scale of those returns and how much capital is actually needed? Because it strikes me you're both very early in both sides of like kind of how these things like happen from a genesis point. So is the bet that like actually that's where the biggest return is going forwards, or is it something different in time?
I think we need to kind of distinguish what we're looking at, whether it is investing into businesses or investing into different types of content. I think when you look at especially film, that is always an individual asset that you invest in. And the moment of where the investment is, I think really matters. We come in at a kind of stage which is kind of production financing, just when it is about to happen. But of course, development in itself is incredibly important to really nurture that idea. What we're really interested in now and really looking into is what we call the new content economy, which is, back to Severin's point, really these types of IP and content that are built with no intermediaries, where it is really direct to the consumer. You build an audience relationship and you build a whole universe of IP that can live as a piece of music, as a game, as content, as merchandise, and everything all at once. What's difficult then talking about kind of early stage, mid stage, or late stage is that it doesn't necessarily follow those same stages. It's much more cyclical. You need to be able to invest into development, distribute at the same time, and keep it going. Like you need to develop and distribute and monetize the whole time. What I think is really interesting is thinking about how do you invest in the ecosystem, into the IP directly, which then allows you to, kick off the flywheel and go from there. And I think lastly is we've done quite a lot of analysis on really understanding exactly that point of what does the funding kind of life cycle look like for businesses in that space, especially in the creator economy and IP-driven businesses. So not necessarily creative tech. And what we've seen is that they don't really need that many follow-on rounds. And I just think it's, again, that nature of that cycle is once you have that audience and this community and the content, you can be pretty quickly, just revenue generating and growing from there. I think there's then these instances of growth financing that can be really interesting, but potentially just for one project, for one new thing that you're trying to do. But that was quite an interesting kind of point that I think we think a lot about, and I think is shaping kind of new investment thesis that we're working on.
I think that's really interesting because so basically you always see everything as a project.
I think there's two ways. I think historically it was everything was a project or a slate. So
and now these projects are becoming these ecosystems, or you want them to become ecosystems.
Yes, exactly. And the question then becomes, if you think of, not necessarily this, but if you think of a good golf in the US or a Mr. Beast or anything like that, right? It's like that's a whole ecosystem and one piece of content will drive the other. So the question is, do you want to be exposed to just one of them? But in a way, the value that's going to be coming from that is driven by all the others. So if we think about investing in this space, you at some point might have to consider investing into the businesses, because the point is, again, if you don't have intermediaries that control that, the value stays within the business. And if you're an IP investor, you go where the IP value is, and that might not be, in the distribution rights. It might actually truly be still in the business with the creators. And so that, I think, changes a little bit how you look at it. And I think we're, exploring all of those different options now to really see, does project investment make sense? Does equity investment make sense? Or should it still be a slate? And I think in the future, there will need to be quite a lot of flexibility because you're kind of in this new world, much more so. And so I think you have to be flexible as well in how you approach it from a financing structure point of view.
That idea is really interesting because it doesn't seem logical that just like relying on the current means of distribution only and their growth through, I don't know, YouTube, Spotify, whatever, is the driver of those value increases that need to happen over time to realize all this value that's coming into IP, which seems like the natural bridge into a world of investing in technologies or companies that are starting to do that. So like that side of the ecosystem piece, I guess, Severin, is that changing the nature of like the old narrative of like kind of disruption? I mean, there's obviously some very disruptive things that are happening, but this seems a lot less about disruption at this point and like much more of a symbiotic relationship between the two things.
Yeah, I think we're seeing disruption everywhere along the value chain, right? Not just like on the creation layer, on the distribution and monetization layer. And to your point earlier, does it change the financing models? Yes, it does, but it's I don't see like a massive disruption here. Both will always exist in the sense like you will have models which don't need a lot of capital. You will have models which need capital earlier and not later on, or vice versa. I mean, my perspective, I'm a very early stage investor, so I'm investing in pre-seed and seed stage. So very often also first check investor in those companies. And obviously, my bet is always like, do they have the potential to become a VC case, right? Otherwise, I wouldn't invest. So it's a very binary look at the companies I'm taking because I need to believe that this can become 100 million or billion or decacorn company. Otherwise, it doesn't make sense for my business model, right? Because I have a huge loss and write-off ratio because it's so binary, right? I'm writing off half of the fund in terms of portfolio count. So I'm still looking for investment opportunities where these are models which need money early on and then can reach a hyperscale state. But I'm seeing tons of very successful companies, and I'm also telling founders very often, take VC money if you don't have to, right? Because you have all the flexibility and freedom. There's probably more tools and more resources to build without need for capital.
And if more and more options become available, both in terms of what you can invest in, what stage you can invest in, where a company or maybe even a creator, to use a broad term there, sits, like how do you help them then decide what to do, right?
I think it really comes down at the end of the day to the founders, interesting enough, right? Irrespectively of which financing modes and asset class there exist. Do the founders want to build a venture case, yes or no, right? And the reality is most people don't, right? And a lot of founders don't know yet because what we see is only the shiny VC stories in the media, right? On LinkedIn or wherever. And everyone feels like, oh, this is what I want to build, right? But the reality is 99% trust me, don't want to build this and should not build this. VC is an asset class for a tiny fraction of the market. And it's also for a very small subset of founders who are crazy and delusional enough to do that, right?
So do we need innovation in terms of like the actual vehicles for investment?
I think there's room for niche categories in all sectors and stages, right? And you can build private equity funds, you can build smaller funds and different strategies. But there is just a reality is often getting overlooked is IP business or creative asset business there is an extremely strong power law, right? It's always only a few assets which make the return that will become successful. And so many people always try to kind of, okay, how can we basically monetize the long tail or redistribute that and or make the shares fairer so that everyone can participate. the reality, this will never happen, is my opinion, because it's just the nature of the business that it's hit driven, right? And there is a power law in those industries, and all the financing models, no matter what, are dependent on that, right? You always bet on asymmetric outcomes and hits.
I was also going to say, like, I think it really depends, like, what, you as the founder are optimizing for, as Severin said earlier. I think it massively depends on that. And especially, let's say, in the film business, if you're doing a film, there's multiple different options of cash flowing things, gap financing, tax credits, there's all these like individual things, but the goal might not even be to have a hit movie. It might just be making the movie and getting paid to being able to, do it. And that is the desired outcome. And that's absolutely fine. I think, but that reality, I often wonder whether it is also knowing what options are out there. It might not even be we need to innovate, and I'm sure there is room for that for sure. But it's also actually just understanding what the options are. I think especially for some creative communities, it can be a bit of a scary thing to think about finance and money and returns. And I think it's, a bit of a, I don't know, just making it a bit more easier, not easier to understand, but just in their language. And I think maybe it's that side as well.
If you think about like a lot of these things that we're talking about, and especially sort of trying to hone in on that idea of building these kinds of ecosystems, one of the things I would say is necessary to do that is a lot of creative research and development. And can that be part of these bets that are being made?
I think it can be, right? But it needs to be, unfortunately or not, right? It needs to be tied to a business model somehow, right? So if you can tie creative exploration and discovery to a business model, and then this is very interesting.
I also think that what I've seen in the creative ecosystem, it's seen as something that's very, very different to the actual creation of what you're doing. So it's off because it is a project-led business. Often it is seen as you have to make one project after the other, and doing an R&D project is another project that you're going to have to do that is so separate to the others. Whereas again, if you're truly building maybe an underlying technology, and then that is being used to create content, a very different business model, and to then have a little bit of your yearly budget allocated to R&D is a completely different game and is part of the business model. But going from that project to project point to then have another project which is disconnected from all the others is really hard, and it's also hard for that business to then truly capture the value of it because it's not connected to any of the things that you're doing. I think it also depends again on like which industry is that business truly in, what is the innovation or the R&D truly supposed to do, and can it benefit the operating business already, which would be the best case scenario.
I think what was also interesting, like going off the path here, but like in the music space, it's quite interesting what we see now happening, right? This AI wave with Suno kind of being the first consumer AI music creation tool. There was obviously a lot of backlash, and rightfully so, right? What has been interesting is like that it's been adopted mainly by people who did not make music before, right? And because the more like music professionals or hobby musicians, they felt like, okay, that's not the tool I want to use, because I want to have a creative process. I need creative friction. I want to be creative in the process, and I don't just want to like type in a prompt and get an output and have no possibility to edit this or adjust the outcome in a more granular way. But what's interesting is to see that the demand is there, right? People want to use those tools, and people want to play around with those tools, and people want to be kind of like expanded in their kind of creative setting. And I think that's a really interesting opportunity to see that democratization of music creation and what it does, and how we are seeing new forms and models of music creation, like thinking of, for example, of multiplayer in a way, right? Making music creation not just a single player experience, but a multiplayer experience, even in a digital world, right? I mean, back in history, obviously it was always a multiplayer thing, right? When you were jamming with the band, but not so much if you're sitting in front of your laptop, right? So it's quite interesting to see that we are rebuilding those creative loops, tailor the needs and demands of professionals and hobbyists.
What's interesting here is like some ways the conversation about value is as much about like the scarcity, like that democratization thing. I've often found it challenging as a concept, or it gets used in a way that's far too flippant. But I think where it seems to be going is much more to this idea of value attributed to access and scarcity in a different way, right? There is a bet that, by having more people making music in a way that was only possible for people with money to buy equipment or release music as artists, etc., like the whole pie becomes bigger as opposed to becomes kind of smaller. And then there's all these questions about control and distribution. One of the things I often think about recently is there's no shortage of entrepreneurs in music, right? I mean, there's incredible people building amazing distribution companies or labels that are then building distribution or artist services, businesses off the back, but they too fall outside of the traditional modes or models for financing and funding in an obvious way. And where are the support structures or the interventions that are happening to help grow that in many respects? And in music, to me, that seems like some of the most interesting questions right now about how does this roll, because that's changed, right? It's no longer massive labels are the place where all that stuff happens. Creative R&D doesn't necessarily happen there. They're not necessarily going to be, they're publicly listed. They're going to buy companies. They're not really going to invest in companies for the most part, etc. So where do these things happen? And I think it's big open questions, right? Like, I don't know where those answers sit.
Agree. Yeah. Very much agree. I mean, I think we will see new categories and markets popping up in those industries which we didn't think were possible before, right? And music creation is, I believe, one of them, right? We will just see. I mean, we saw that in the design space, right? Before Canva and Figma, the number of designers was significantly lower, or people creating designs.
And the same in music, right? Before
exactly.
BandLab, before Ableton, and all of those kinds of DAWs things.
Yeah, exactly. So at some point, there was no need to actually play a music instrument anymore because there was digital ways to represent it. And now we're seeing the next wave of that. That usually increases the pie as well.
And I think also the way we look at it and connecting it a little bit to the technology question is, what new types of content or new types of experience is new technologies or are new technologies really going to enable that might look nothing like the things that we already know. And it could be, often in the content or audiovisual space, it's often about, could you afterwards have a conversation with your favorite character that you've been watching or whatever it might be? All these kinds of, I think, new types of experiences are really going to be truly interesting. And again, from an IP point of view, could increase the value of that IP. And so I think we often think about it, what kind of new things could it truly unlock, rather than necessarily even just innovating within the set structures that already exist. And that, in essence, would, of course, as well expand the pie, but just in unexpected ways.
Is that also kind of referring to, I think you had that, right, Victoria, in your research, revenue per user per hour, seeing how can you basically increase that value? For example, because it has been very low at this point in time in the music space, how can you increase that and how can you make this a transmedial experience potentially, and combining it with other IP or other experiences?
Yeah, exactly. We did this analysis on how valuable is 1 hour of consumption depending on the medium, based on data from McKinsey. And what was kind of really interesting is that social video or audio was pretty low. I mean, media value averagely is around 30 cents an hour, audio being quite low, and the highest was live experiences, followed by theatrical, kind of merchandise and physical products. And the view is a little bit like, but the bottom ones have so much more scale in terms of people it can reach. Of course, distribution, global, etc., can really drive discovery, fandom, all of those elements. But the value that is really being captured can very much be at the top. And of course, that's been true in the music business with live tickets and touring, etc. But it's also the same in film with buying, cinema tickets. It's much more valuable than watching it on Netflix. Same thing with gaming. If you can buy the CD, all these kinds of things are very, very similar. And so when we think about how can you truly create something that's valuable, you have to be ideally across all these different things. And technology helps to be able to do all these things, often simultaneously. And then I can imagine in the future, there'll be an even bigger pyramid that has like all these other layers on it with mediums maybe that we don't even know. It could be one layer is conversational AI for IP. And that is maybe one layer that is incredibly lucrative, maybe not. But I think that is, for us, is an interesting way of thinking about it purely from a IP and content value point of view.
That makes for quite an interesting, I mean, not free of challenge, but like thesis around creators generally in terms of musicians, musician creators, exploring more of a universe, things and opportunity, just very much changes a moat from thinking about in very linear definitions of, well, this is what music is and this is what artists do and this is how they make money, into something that's more expansive. Kind of feels like you need a bit of a mindset shift if you want to capitalize on that side of thinking about how these things, well, otherwise you're beating your head against a wall of, streaming economics, et cetera, et cetera. I mean, how you solve that is a different issue. I don't want to underplay how challenging it is to be an artist or creator at this time.
Well, like, it's just interesting to see. I mean, like, I remember the first conversations a couple of years ago, right? Is AI killing creativity? And it was really like, is it the end of creativity? And everyone was afraid and like, what the fuck, right? And like now, the same audience is kind of exploring those tools and kind of figuring out in new creative ways what we can build and what we can achieve. And I think that's super, super interesting, because creativity will never go away, no matter which technology is being implemented or innovated.
And I think, Gareth, to your point about, creators and the roles that they play, I think obviously a huge thing for musical artists, but also video creators, is of course that suddenly you are not simply in your thing, you're suddenly doing everything. And there's this great article, Everyone's a Sellout Now, which basically argues that you now have to be your personal brand manager, you're a marketeer, you're all doing all these things. And it's kind of taking away time from sometimes for the reason why people started to do what they're doing. And of course, ultimately, especially in the music space, they might be able to get better deals with the labels. But I've also seen it in the gaming space where suddenly they're like, we've done all of this ourselves. Why do we even need a game publisher or anyone else? We'd much rather work with a VC or anything like that, because we've built our audience. We've done all of this ourselves in the first place. But I think it can give a lot of power to these entrepreneurs and founders and creatives, but at the same time is, of course, is an incredibly large workload, is a lot to do, a lot of different skills to have. And that, I think, is also not to be underestimated and is also not for everyone.
We touched on a lot of things here, and everything is sort of blurry, which is fun, right? So there's a bunch of us here who are trying to find some answers to how to look into a future and make that a reality.
Anything you guys want to add?
Closing statements.
Yeah.
I'm extremely excited about the creative industries from a tech perspective, from a VC perspective, from an IP perspective. I think now is an extremely interesting time to build, to invest, basically ride the wave and find new ways of being creative and reach audiences. I think it's now is the time.
Yeah, I kind of echo what Severin says, and I often say, now in this kind of brave new world, so to say, there are no real rules, and so how exciting is that? We can all write our own and be a part of, shaping what that looks like, and what a great time to be building and experimenting with things. So I think it's super exciting.
If you like this episode and want to learn more about the archives of MusicX, whether it's our podcast or the newsletter, you can find everything on our Substack, musicx.substack.com. As a reminder, MusicX is a strategic intelligence collective that provides critical analysis, future-gazing frameworks, and hype-immune insights. It's a newsletter and now a podcast for innovators, strategists, artists, and founders in the music ecosystem who all need to navigate the ethical and structural shifts of advanced technology's impact. I hope to see you around.